Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 24th of November. I'm Daniel Lam, your host for the podcast. U.S. equities have been volatile. The September non-farm payroll, released last Thursday, was stronger than expected. It rose by 119,000 jobs after a downwardly revised 4,000 drop in August. This echoes what we discussed in a podcast last Tuesday, that a steady, or in this case, strong non-farm payroll number would lead to a further reduction in the likelihood of a December rate cut. The markets did not take this well. Post the release of this non-farm payroll number, U.S. equities opened high and closed at the day low, with increasing volume of selling across the major stocks. A strong non-farm payroll number meant inflation may not be reducing significantly in the near future, but unemployment rate did go higher. That showed doubts about the economy. Finally, to top it off, valuation is expensive, and this provided the perfect context for some investors to be taking profit. Moreover, there are trend-following investors, or the CTAs, that will need to offload stocks if the index hit technical levels. This can exacerbate the correction. Now, in the aforementioned podcast, we said that 6,600 and 6,400 are two important technical levels for the S&P 500 for these trend-following funds. So now the question is this a buying opportunity? Well, we discussed before that US equities positioning is less crowded now, but still hovering around the +1 standard deviation mark. If the positioning drops to more neutral territory, then we may see more solid stabilization. In this kind of environment, it is key to check stocks which demonstrate characters of defensive growth. Now, US pharmaceuticals, their valuation is inexpensive versus the broader US market, trading at close to 1 standard deviation discount relative to the 12-month forward price earnings ratio. Now, its main headwind is the regulatory uncertainty, but this risk is receding as pharma companies are agreeing on pricing and tariff concessions with Trump. US utilities is also interesting. The sector offers defensive earnings growth and reasonable valuations. Data center boom support electricity demand growth over the next decade. The US electricity demand can grow at twice the pace over the next decade versus this one. So this can accelerate earnings growth. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.